Today's video is sponsored by Graniteshares, a potential high-income ETF with a 12.2% 30-day SEC yield and potential monthly distributions as of June 30th, 2026. HIPS has paid 10.75 cents per share every month since December 2015. And how does it compare to Fidelity's FXNAX and Vanguard's BND? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, one of the biggest topics that we've been talking about regularly on this channel and on an almost daily basis in our VIP investment club is this. With short-term rates coming down, where can investors still find higher yielding income opportunities? Everyone loves higher yields, but in our Diamond NestEgg community, the folks asking this question typically fall into three groups. Group 1. They already have a strong foundation of fixed guaranteed payments for retirement from sources such as Social Security, annuities, treasuries, and or other types of bonds. Some very lucky ones also have a solid company pension. They can now afford to take on a bit more risk for a bit more return, either within their fixed income portfolio or even outside of it. Group 1 basically already has their expense base covered for their later years, and the safe and or stable higher yielding income opportunities are just nice to haves, kind of like the cherry on top. Moving on now to Group 2. They do not have sufficient income for retirement and need higher yields to cover their ongoing outflows. For Group 2, safe and or stable higher yielding income opportunities are not nice to haves, but rather must haves. And people who fall in this group, they may be less concerned about capital growth and preservation so long as they can generate the income they need. And Group 3, they want more stability than what the equity markets can offer currently, or maybe just a bit of diversification, but they don't want to give up on yields either. Some of the folks in Group 3 may not even be thinking about retirement, but are rather worried about an AI or tech bubble, for example. Regardless of which group you fall into, though, you should know that stable, higher yielding income opportunities do exist. They're not always easy to find, and sometimes they can be complex, so you may need to take a bit more time and effort to understand whether they might be something for you. But that's why you have us. So, with that in mind, here are the three topics I'll be covering today. 1. What is the track record of Graniteshares HIPS US High Income ETF, ticker HIPS, and how does it compare to a core bond fund? In this section, we'll be comparing HIPS to two popular fixed income choices in our community, Fidelity's US Bond Index Fund, FXNAX, and Vanguard's Total Bond Market ETF, BND. 2. Where does the 12.2% 30-day SEC yield on HIPS at the time of this taping as per June 30th, 2026 come from? And how has the fund managed to pay out a stable 10.75 cents per share every month since December 2015? Basically, what does HIPS invest in? And 3, who might want to buy HIPS and who might not want to buy HIPS? Let's dive in now, folks. What is the track record of Graniteshares HIPS US High Income ETF, ticker HIPS? And how does it compare to a core bond fund? For those of you who may not know Graniteshares, they describe themselves as a global asset manager that provides innovative, cutting-edge investment solutions for the high-conviction investor. Graniteshares has grown fast since it was founded in New York in 2016, with backing from Bain Capital Ventures and other leading ETF investors. They manage $10.9 billion in AUM as of September 19th, 2025, the latest official number on their website. And the HIPS US High Income ETF is just one product offering within Graniteshares' broader suite of ETFs, which also cover gold, platinum, commodities, disruptive technologies, and leveraged single stocks. Graniteshares is actually best known in the market for offering single stock ETFs that allow investors to place targeted bets on select companies. These single stock ETFs are not what we will be discussing today. In fact, Graniteshares US High Income ETF, HIPS, that we will be talking about today is pretty much at the opposite end of the spectrum in the sense that it is a much more diversified product, the investment objective of which is to generate high and stable monthly cash distributions for its shareholders from a broad portfolio of alternative investments. At the time of this taping, as per June 30th, 2026, HIPS shows an attractive 30-day SEC yield of 12.2% and has been paying the same distribution, exactly 10.75 cents per share every month since December 2015, as we touched upon in the beginning. So, more than 10 years. You could describe HIPS as a fund of funds at its core. This means that HIPS is an ETF that buys shares in other investment vehicles, such as other ETFs, closed-end funds, REITs, and master limited partnerships, or MLPs. And what's so special about the investment vehicles in HIPS portfolio, these here, is that they're all known as pass-through securities. Pass-through securities are investment vehicles that are required to distribute almost all of their earnings to shareholders every year. We'll be covering this in greater detail later on after we go through the numbers, because fund of funds and pass-through securities like these are not always straightforward. So, let's dive into our comparison of Graniteshares HIPS U.S. Income ETF with other funds using a Diamond NestEgg table. And please note that while these funds may all be considered for income, their strategies, underlying assets, and sources of distributions can differ significantly. Here we have the fund name, followed by the fund ticker and when it was established. In the next columns, with the total AUM, or assets under management, in billions of dollars. The distribution frequency, meaning how often cash distribution is paid per year, and the expense ratio. Then we have the price per share, as well as the 30-day SEC yield, and the TTM, the trailing 12-month distribution yield, as calculated by Morningstar. Both of these yields tell us how much in cash the fund distributed to its owners as a percentage of the share price at the end of the observation period. The primary difference is that the SEC yield takes the last 30 days and annualizes the distributions, multiplies it by 12, while the TTM takes the actual cash distributions over the past 12 months. And in this section, we have the trailing total returns on an annualized basis. These numbers tell us how much a shareholder would have made overall from both distributions and capital gains or losses, meaning basically from both cash payouts and share price changes, had he or she invested 1, 3, 5, or 10 years ago. And please note that all numbers in the table are sourced from Morningstar, Yahoo Finance, and company websites as of June 30th, 2026, the time of this taping. They will change over time, so please always make sure you check for the latest updates whenever you watch this video. So, starting with Graniteshares HIPS US High Income ETF, ticker HIPS. It was established in January 2015, a bit more than 11 years ago, and is the smallest amongst the three funds that we are comparing, at about $100 million. HIPS pays distributions around 12 times per year and is relatively expensive, with an expense ratio of 1.17%, which includes a 70 basis point management fee plus 46 basis points of pass-through expenses from these different types of funds and investment vehicles it holds in its portfolio. Pass-through expenses are one of the disadvantages of the fund-of-fund-like structure of HIPS, because you need to pay for the expenses of the underlying funds that it owns in its portfolio as well. That said, do keep in mind that this expense ratio is already deducted from the cash yields and total returns in this table that we're about to cover, meaning any numbers you see in this section here are already net of this expense ratio number. There's no need to deduct them again. And as a reminder, all the numbers that we're about to walk through are based on historical performance and not indicative of future results or outcomes. So this 30-day SEC yield of 12.2% and TTM cash distribution yield of 10.65% for HIPS are clearly attractive in the current market environment and probably the main reason why someone would consider investing in HIPS. Plus, as I said already, HIPS distribution has stayed exactly the same at 10.75 cents per share every single month since December 2015. The trailing total returns are 6.34% for the past year, 10.31% for the past 3 years, 4.07% over the past 5 years, and 5.59% over the past 10 years. Now, last year wasn't that bad, and the trailing total returns over the medium and long term are respectable numbers as well for an income-focused investment. Let's dive a bit deeper now and add two core bond fund fixed income choices to this table that are quite popular in our Diamond NestEgg community. The Fidelity US Bond Index Fund, ticker FXNAX, and the Vanguard Total Bond Market Index Fund ETF, ticker BND. Remember, HIPS is a fund of funds, not a bond fund, and has a different risk profile. But the stability and predictability of its monthly distribution payments for the past 10 plus years may make it a partial competitor and or supplement for the fixed income portion of a portfolio for some yield-seeking investors. So, FXNAX was established in 1990 and BND in 2007. Both track the same Bloomberg U.S. Aggregate Bond Index, have assets in the double or even triple digit billion-dollar range, pay monthly cash distributions, and charge very low fees of 2.5 and 3 basis points, respectively. So it's no surprise that their track record is very similar to one another, give or take a few basis points. Cash distribution income for FXNAX and BND stood at 4.43% and 4.5%, respectively, for the 30-day SEC yield, and at 3.71% and 3.95% for the trailing 12 months. All of these numbers are less than half of HIP's cash distribution income of 12.2% and 10.65%, respectively, per June 30th, 2026. As for trailing total returns, FXNAX and BND showed total returns of 3.77% and 3.69%, respectively, versus HIP's somewhat higher 6.34% for the past year. This picture remains similar when we look at the medium and longer term. Over the past 3 years, HIP's produced total returns of 10.31% on an annualized basis, while FXNAX and BND both remained in the 4.1% range. Over the past 5 years, HIP's produced total returns of 4.07%, whereas FXNAX and BND both showed barely positive total returns of 0.05% and 0.06%, respectively. And over the last 10 years, HIP's produced total returns of 5.59%, while FXNAX and BND showed both total returns of only 1.5% and 1.51%, respectively. In other words, when you look at these historical numbers, you can see that HIPS had both higher cash distributions and higher total returns than the core bond funds over the past 1 year, 3 years, 5 years, and 10 years. So far, so good then. But let's dig a bit deeper now into one aspect of this comparison that comes up a lot in discussions. Remember that total trailing returns include both cash distributions and capital gains or losses, essentially share price movements. So the fact that the trailing total returns are lower than the cash distributions for HIPS, FXNAX, and BND is an indication that share prices may have declined over time for all three of them. And that's indeed the case. If we look at the past 5 years here on Yahoo Finance, at the time of this taping as per June 30th, 2026, for example, HIP's share price is down 27%. But the last 5 years overall were not that great for medium and longer term fixed income investments generally either. And indeed, and as we already suspected, the shares of both FXNAX and BND, while a bit less volatile, declined by double-digit percentages as well over the past 5 years, at minus 14% and minus 14.5%, respectively. There are, however, 2 more reasons specific to HIPS that can lead to its share price declining more than core bond funds in the longer run. Reason 1 may be the most obvious. While the distributions for both FXNAX and BND have fluctuated with the market, HIPS has been paying exactly the same 10.75 cents per share every month since 2015, as you can see here. And this stability may come at a price. In good years, HIPS may be able to cover the cash payouts from what it takes in from its underlying investments. But in not so good years, HIPS may have to sell some underlying holdings to cover the payouts. Bringing us to reason 2 for why HIP's share price may decline more than core bond funds in the longer run. This is partially a reflection of the fact that the underlying investments of HIPs are all pass-through securities that similarly prioritize high cash payouts over capital growth. And that's another fundamental money and investing concept, like the high-risk, high-return rule that most of our Diamond NestEgg regulars are already familiar with. You generally cannot have both high income and high growth, capital gains, at the same time. Because by definition, if a company or fund is making high payouts to you and its other investors, that means it has less money to reinvest internally for long-term growth. And that's why high income and high growth do not easily go hand in hand. There's nothing necessarily wrong with that. If you want or need the income, it makes sense to invest in a fund with potentially stable and high cash distributions and to deprioritize capital growth. You just need to make sure you understand the risks and remember that you may not see much, if any, capital gains or even suffer capital losses when looking at the share price alone. But if a declining share price, the capital decay or NAV erosion as the industry calls it, was something you really don't like, there may have been a simple remedy. As we just saw, over the past 5 or 10 years, the cash distributions from HIPs were on average higher than the share price declines. So, if you wanted to keep your capital stable or even grow it, you could do so by simply reinvesting a part of your distributions. Here's an illustration of what we mean. Let's assume that 5 years ago, you bought one share of HIPs for $15.81. Over the past 5 years, the share price has gone down by 27%, as we showed you earlier. So now, your share would be worth $11.54, a loss of $4.27, which doesn't look too good at first glance. However, over the same 5-year period, HIPs would have paid you distributions of $10.75 per share every month, giving you a total cash payout of $6.45 over the same period. That's $10.75 times 60 months. From these total distributions of $6.45, you could have easily reinvested $4.27 back into HIP shares to make up for the declining share price and keep your total capital stable. And in the end, you still would have had $2.18 left as free cash flow, so to speak. As always, please keep in mind that this example is illustrative and that past performance does not guarantee future results. And one more remark, because over 50% of HIP's distributions have been historically treated as return of capital, which defers taxation, you could even have bought most of these additional shares without having to pay income tax first, even in a taxable brokerage account. That said, in my mind, most investors, when they buy HIPs, may care less about the share price and more about the potentially high income as an addition to a core fixed income portfolio. In other words, they may focus more on the potentially high and stable HIPs distributions. The track record of 10.75 cents per share every month since December 2015 for HIPs versus the distributions from FXNAX and BND, which were more volatile as they fluctuated with the market over time. So, here are the key takeaways for HIPs so far. 1. HIPs shows an attractive 30-day SEC yield of 12.2% at the time of this taping as per June 30th, 2026, and has been paying the same distribution income for over 10 years, exactly 10.75 cents per share every month since December 2015, including through the ups and downs of COVID. 2. HIPs had a higher 30-day SEC yield, meaning higher cash distributions at the time of this taping, as well as higher total returns over the past 1, 3, 5, and 10 years than FXNAX and BND. And 3. As an alternative fund, HIPs may offer some diversification benefits in your overall portfolio. Plus, HIPs portfolio is diversified as well. But because high distributions generally come at the expense of capital growth, all of these potential advantages of HIPs may come at the expense of a declining share price over time. But if that's something that was important to you, you could easily have reinvested a part of your cash payouts to keep your principal stable and still have a good part of free cash flow left. So, now that you have a good overview of HIP's track record and how it compares to two popular fixed income choices in our community FXNAX and BND, let's move on to the next part of today's discussion. Where does the 12.2% 30-day SEC yield on HIPS at the time of this taping as per June 30th, 2026 come from? And how has the fund managed to pay out a stable 10.75 cents per share every month since December 2015? As we touched upon earlier, HIPS is basically a fund of funds at its core, an ETF that buys shares in pass-through securities that are required to distribute almost all of their earnings to shareholders every year. HIPS follows the EQM High Income Pass-Through Securities Index and basically splits its portfolio equally into 4 categories of a rounded 25% each. Closed-end funds, MLPs or Master Limited Partnerships, REITs, Asset Management and BDCs, Business Development Companies. Now, this list is ordered by allocation percentages, the differences of which aren't all that large anyway, but we'll go through these different categories in what we think may be a rough order of familiarity, starting with REITs, Real Estate Investment Trusts, because they are an investment that many in our community are familiar with. As a refresher on how REITs work, REITs are required to invest at least 75% of their assets in real estate and or real estate mortgages, derive at least 75% of their income from real estate related sources, and to distribute at least 90% of their taxable income to shareholders every year. And this last feature, the requirement to distribute at least 90% of their taxable income to shareholders every year, is what makes them a pass-through security, because they cannot really keep much of their profit back to reinvest or for any other purposes, but must pass the cash on to shareholders. If you'd like a deeper dive into REITs, I've linked this recent REIT video below for you. So, REITs come in many different flavors, as we like to say here at Diamond NestEgg, and HIPS will invest in a wide range of them, including mortgage REITs, commercial equity REITs, and residential diversified REITs. At the time of this taping, HIPS holds some REITs that we've been discussing in our VIP investment club recently, such as Starwood Property Trust, STWD, and Annaly Capital Management, NLY, but also names that may be less well known in our community, such as the Arbor Realty Trust, ABR, and the Armor Residential REIT, ARR. All these 4 examples are mortgage REITs, by the way. Moving on now to closed-end funds, often abbreviated as CEFs. CEFs are funds that raise a fixed amount of capital by issuing shares through an initial public offering, IPO, and then investing that capital in a portfolio of securities. Once a CEF is listed on an exchange, the amount of shares is fixed and cannot be changed. This is unlike open-end mutual funds or ETFs that many retail investors purchase, which can create or redeem shares during their life. The price of a CEF on the stock exchange follows the laws of supply and demand, which also means that if you buy or sell them on the market, they can have a premium or discount against the fund's net asset value. Closed-end funds are generally actively managed and can use leverage, borrow money in other words. HIPS will generally hold closed-end funds that are income and distribution oriented and invest in bank loans, high-yield securities, junk bonds, foreign securities, including from emerging markets, as well as mortgage and asset-backed securities. Examples in HIPS portfolio include the PIMCO High Income Fund, PHK, the Franklin Limited Duration Income Trust, FTF, and the BlackRock Debt Strategies Fund, DSU. All these closed-end funds follow their own strategies, but they will often have average credit ratings in the double to single B range. Asset management and BDCs, business development companies. BDCs are a specialized type of closed-end fund that was created by Congress in 1980 to provide financing to small and mid-sized U.S. companies, including emerging businesses and financially distressed firms. To that purpose, BDCs can give loans, make equity investments, or provide mezzanine capital that is structured somewhere in between debt and equity. BDCs can also use leverage. One interesting aspect of BDCs is their risk profile. Many, if not most of the small and medium-sized businesses they invest in are generally not rated, or if they have a rating, that rating is typically non-investment grade. However, because each BDC holds an entire portfolio of financings and is often very proactively managed, some BDCs with a good track record can get to an overall credit rating that is better than the sum of the parts, so to speak. This explains why some of the BDCs in HIP's portfolio have BBB ratings at the time of this taping, which is investment grade, although at the lower end of the range, including the Goldman Sachs BDC, GSBD, the Barings BDC, BBDC, and the Golub Capital BDC, GBDC. Up next, we have MLPs, or Master Limited Partnerships. They're traded on a stock exchange, but they don't have regular shares. Instead, they issue so-called units that give you a limited partnership stake in a business. You technically become an entrepreneur, meaning you share in the profits and losses of the venture. However, your liability is limited to the amount of your investment. That's different from a general partnership, where you would be personally liable with everything you own for the debt of the venture. If you hold an MLP unit directly, you may benefit from some special tax advantages for entrepreneurs. But the tax treatment can get very complex if you get sent a Form K-1 at year end. If you invest via HIPS, though, you simply get an ordinary tax form 1099 like for any regular bank or securities investment. In return, however, you also can't claim any special deductions in your personal tax returns anymore. MLPs are popular with private investors for the production, transportation, and processing of energy, and it's no surprise that HIPS owns units in this field. For example, the relatively well-known Enterprise Product Partners, EPD, and the Western Midstream Partners, WES, both own and or operate what the industry calls midstream infrastructure like pipelines and storage facilities for oil and gas exploration. But HIPS also holds units in Alliance Resource Partners, ARLP, which owns and operates coal mines, as well as various royalty MLPs that own mineral rights, drilling and pumping rights, if you want, for oil and gas. Within each of these four categories that we just discussed, HIPS buys 10 investments in equal shares. The holdings are rebalanced quarterly, and the index is reconstituted, adjusted every year. The overall result is that HIPS holds a portfolio of 40 income-generating pass-through securities, so 10 REITs, 10 closed-end funds, 10 BDCs, and 10 MLPs, each accounting for about 2.5% of the portfolio. Right. So now that you have a good overview of HIPS, its track record, and what it invests in to achieve its current 12.2% 30-day SEC yield, and its distribution history of paying 10.75 cents per share every month over the past 10 plus years, let's move on to what we think is the most interesting part of today's video. Who might want to buy HIPS and who might not want to buy HIPS? In our personal opinion, HIPS might be something to consider if you check all these boxes. 1. You're looking for a fund focused on providing cash distributions, potentially paid monthly, with a history of regular distribution payments. 2. You appreciate that a large portion of the fund's total return has historically come from cash distributions. However, these distributions can be associated with a decline in the share price, meaning the value of your investment may fall over time. If you choose to reinvest distributions, you're committing additional capital to purchase more shares. This does not prevent losses or restore any decline in the value of your original investment. 3. You like that HIPS diversifies its portfolio across 4 pass-through asset classes beyond pure equity and fixed income options, and are comfortable with the resulting overall risk profile. On the flip side, HIPS may not be for you if you're a very conservative investor who appreciates safety above everything else. To produce its cash distributions and trailing total returns, HIPS does take on a commensurately aggressive level of risk in its underlying portfolio. With all or some of the underlying alternative investments that HIPS holds, you may be exposed to leverage, interest rate risk, credit risk, and entrepreneurial risk, among others. And even though HIPS has a diversified portfolio, most of the underlying positions are not investment grade in their own right. You're looking for real assets and inflation protection. There are alternative investments out there that can give you that exposure, and HIPS can even own a few of them, like, for example, equity REITs. But you would be better served by buying them directly if that's what you're focused on. As we said before, HIPS is a high-income solution and should really be considered as such. Adding HIPS to your portfolio would keep you up at night for whatever reason. It is a product that holds complex and higher risk alternative investments and may require a bit of time and effort to understand. As I often say, sometimes that potential extra yield is just not worth the extra worry. Now, we in the Lammer family don't own any HIPS currently. We still have a long runway to retirement, and our portfolio is very much in the growth phase, meaning mostly invested in equities for their long-term growth potential. But if we were closer to retirement or already in retirement and looking for potentially higher and stable monthly income in the form of distributions and potential return of capital, we would certainly consider adding some HIPS to our overall diversified portfolio. We wouldn't put 100% of our money into HIPS, but remember, it's rarely all or nothing when it comes to money and investing. And besides, putting all your eggs into one basket is hardly ever a good idea. In an ideal world, the monthly cash distribution from HIPS would supplement the guaranteed income streams from our Social Security, annuities, and other bonds. But that's us, and everyone's financial journey is different. What about you? Are you thinking of adding some HIPS into your portfolio for some potentially higher cash yields every month? Why or why not? And what other questions do you have about HIPS? Or do you have other higher yielding income alternatives that you want to share with everyone? Drop a comment below and let me, Marcus, and the rest of our community know. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed this video and learned something new. And see you again soon with more brand new wealth building content for your financial journey.